Greeting everyone. Continuing to the long-term and the short-term capital gain and long-term and short-term capital loss, there are some points that we need to keep in mind that is there before you. Okay, so this is important that we just understand them. Let us go one by one. In case of property received in a will, the cost inflation index will be, that is CII, will be taken for the year in which the property was purchased by the previous owner. Please understand this. The CII will be the year in which the previous owner has purchased. For example, your father purchased a house in the year 2006, but you got it in 2016. So while you are indexing it, the CII for that purpose will be taken for the year 2006. Okay, this is very important. Then I repeat that ignore the improvement cost if it is incurred 2001, as already explained. Then index benefit is not allowed in the case of bonds or debentures except capital indexation bond or sovereign bonds issued by the RBI. So please, you have to pay attention to this point when you are computing the capital gain on bond, whether they are capital indexation bond or sovereign gold bond, then you will have to decide accordingly. Then starting 1st April 2023, the indexation benefit is not available for debt funds. This has been done away with. These are some specific revisions that I am bringing to your notice. Okay. After that, the last point, it says starting 23rd July 2024, the indexation benefit is not available for any assets. So if we are working on any calculation part after 23rd July 2024, we are not going to take into consideration the indexation benefit. This is very important, and further there are some more revisions done in the financial bill also, which we will discuss later on. Okay. Moving ahead further, before we move to other conceptual part, let me just discuss one more illustration with you to make things more clear to you. Okay, so this is the question that we first I'll read. We have before us. P sold a house property on 30th June 2024 for rupees 7,50,000. He had acquired this property from O under a will on 1st June 2011 and expended rupees 36,800 on its improvement in 2011-12. Please remember, this house is sold before July 2024. Otherwise, indexation would not be implemented. Okay, it is on 30th June 2024. Now, compute P's income under the head capital gain for the assessment year 25-26, assuming that O has acquired this property at a cost of rupees 1,40,000 in 2001-2. And further, he spent 15,000 during the same year on its improvement. That is, again, it is within the within that 2,000, because if it would have been prior to that, we wouldn't take into consideration. The cost inflation indices are given in the question, that is 2001-2 it is 100, 11-12 it is 184, and 24-25 it is 363. So after reading the question, let me just highlight few of the figures here. That is, the house was sold for 7,50,000. So the FVC is rupees 7,50,000. Okay. After that, he acquired the property on 1st June 2011, and the property he acquired on this and expended rupees 36,800 on its improvement in that 2011-12 itself. But he has received this property on will, okay, under a will, sorry. So we have to compute, he has not purchased it. So for him the cost will be what the cost was borne by his father or grandfather, whoever. So here it gives you cost of acquisition was rupees 1,40,000 for whoever acquired. Further improvement was 15,000. So let us find out the cost of acquisition. I am not indexing it just now. Cost of it is 1,40,000 and COI at that time, that is 2001 to 2, in that year, it was 15,000. So for him it was 1,55,000. Now cost of acquisition was 1 lakh in 2001, 2002. But there was again cost of improvement, or maybe an expansion, whatever. It was in 2011-12. It was rupees 36,800. Okay. Now these are the years back. Obviously it is a long term, so we have to index it. Okay. So let us calculate its indexation. Indexed COA is equal to 1,55,000 into the current year's indexes. CII is 363 divided by base year, because it was purchased in 2000, means not purchased, but yes, acquired in 2001. So that will be 100. So it comes down to 5,62,650. So this is the rough work we are doing here. Okay. Similarly, indexed cost of improvement is equal to 36,800 into 363 divided by 184, which comes down to 72,600. Okay. So these are the two values which are there. If we just add them together, 0, 5, 2, 6. Sorry, this is 5. 6,35,250. 6,35,250. So we have to compute the long term capital gain. The FVC was 7,50,000 and index cost of acquisition plus improvement is equal to 6,35,250. So 1 lakh, sorry, this is 4, 9 minus 5, 1 lakh. So your LTCG is equal to 1,14,750. So this is how we compute the long-term capital gain. Okay, I hope this is clear. Let us move on to next slide. Now we come to the next part. What is FVC? Because till now, yes, we do understand it, but now we are going to study it in detail. So FVC means the amount which is received by the seller or the transferor in exchange for transferring a capital asset. This is something, maybe you sell an asset, whatever you get in return will be called FVC, that is full value of consideration. But there are some important points that are to be remembered. some key points. First, consideration received or receivable. So, because we have to be very clear before taking the decision whether we treat it as FVC or not. So, the first thing is whether it is received or receivable. So, it does not matter whether you have actually received the money or not yet, not received it yet. Even if it is receivable in future, it will be included in the FVC. Okay. Then second point, important point to be kept in mind is that consideration may be in cash or kind. That is, you may receive cash or property, or you may receive cash or maybe asset. So, in kind, both are valid. Both things will be, if it is cash, well and good. If it is some property or asset, then equivalent value will be taken into consideration. Third important point to be kept in mind is that if received in kind, then use the fair market value, because you have to calculate the valuation, you have to calculate the amount. So, if the consideration is not in cash, in that case we take the fair market value of that asset, because tax cannot be calculated without a monetary value, obviously. This is something, these three points are very important to be kept in mind. Then there is an important concept about that is the notional consideration. Is there? There's something, sometimes law does not accept actual consideration. Instead, it substitutes a deemed or notional value. Now, let us see what are the situations where FVC will be taken as a notional value or notionally. Under the Income Tax Act 1961, actually FVC is replaced by the deemed value in certain cases. For example, if it is Section 50C. Section 50C says, it says sales of land or building, stamp duty value is taken if it is higher than the actual price. Please remember this, sale of land or building, and in that case, stamp duty value is taken if it is higher than actual price. Then Section 43CA, that is sale of stock in trade, that is real estate. Okay. Section 50D, where when consideration is not ancestral, FMV is taken as FVC. And Section 50CA, transfer of unquoted shares, FMV is considered if higher. Okay. So, these are the points you have to keep in mind. Suppose just to make it more clear, a property is sold for rupees 10 lakh. The stamp value is equal to 15 lakh as per section, and the stamp value is rupees 15 lakh. Then as per Section 50C, the FVC will be 15 lakh and not 10 lakh. That means that FVC will include the stamp value also. Sorry, will include the higher of the two, that is stamp duty value, that is 15 lakh. This is called deemed consideration. I think this is what we did in one of the illustration just now. There are some common mistakes which we have to avoid. What are those common mistakes which are often found? That is taking the actual price when even when the law says otherwise. Ignoring, or maybe another mistake you may commit is ignoring the FMV when the consideration is in kind. Or maybe you are forgetting any of these relevant sections, that is 50D, CA, 43 CA or 50C. These four sections are very important to be kept in mind and taken into consideration. So, please do not commit those mistakes. Always remember, FVC is the starting point. As we have already done 3-4 questions and you understand that this is the figure we start with. Okay. It may be actual or deemed, and choosing the correct FVC is half the question solved. Okay. So, this has to be kept in mind to understand the FVC more clearly. So, we move on to another small question, that is, let me read out first to understand these things, what we have discussed in the past. A firm is dissolved. Its one short-term capital asset costing rupees 1 lakh is taken over by the partner at an agreed price of rupees 1 lakh 10,000, whereas the fair market value of the asset is 1 lakh 50,000. Now we have to compute the capital gain. So let us, the cost or COA is rupees 1 lakh. It is taken for by a partner as an, so it is other than sales, it is for some other consideration for rupees 1 lakh 10,000, and the FMV of this is 1 lakh 50,000. So the capital gain, it's very simple. We will consider obviously the fair market value of the asset, which is rupees 1 lakh 50,000. Because 1 lakh 50,000 is the fair market value, though the partner has agreed to pay 1 lakh 10,000. But here the cost is 1 lakh. So the capital gain is, capital gain is 50,000. Simple. 50,000. We are not going to take into consideration the 1 lakh 10,000 which has been quoted or maybe agreed by the partner. We'll take the fair market value. Okay. I hope this is clear. C1. After understanding the FVC, the meaning of that, let us go into detail to understand that what different nature of transaction will lead to different full value of consideration, decision regarding the FVC. So, under the provision of the Income Tax Act 1961, the term FVC generally refers to the amount received or receivable by a transfer or on transfer of a capital asset. So, in normal situation, this consideration is the actual sale price agreed upon between both the parties. However, there are certain special transactions where the actual consideration may either not exist, may not reflect the real value of the transfer, or the transfer may occur in a manner different from an ordinary sale. In such cases, the Act prescribes the deemed or notional full value of consideration to ensure the proper computation of capital gains. So let us understand them one by one. Actually, in the previous, where I explained you the notional, so these are some notional situations where we take the deemed FVC. Okay. So the first point where it talks about section 45 subsection 1A, when a capital asset is damaged or destroyed due to events such as fire, flood, riots, earthquake, accident, or any natural calamity, and the owner receives compensation from an insurance company, then section 45 subsection 1A becomes applicable. In this situation, the compensation received from the insurer is treated as consideration for transfer of the asset, even though no actual sale has taken place. So the compensation may be received either in money or in the form of another asset. So if money is received, that amount becomes the full value of consideration, obviously. If an asset is received in exchange instead of cash, then the FMV of that asset on that date of receipt is taken into consideration as of FVC, obviously. So does the law, hence here we can see that the law treats, in this case, the law treats insurance compensation as a transfer for the purpose of taxing the capital gain. Next we have section 45 subsection 2. This deals with the conversion of the capital assets into stock in trade. This situation commonly arises when an individual converts an investment asset such as land or building into business inventory. Since the nature of the asset changes from the investment to trading assets, the law considers it as a transfer. So, in such a case, the fair market value of the asset on date of conversion is treated as the full value of consideration for the purpose of computing the capital gain. Although the capital gain arises at the time of conversion, the tax on such gain becomes payable only in the year in which the stock in trade is actually sold. So, this provision ensures that the appreciation in the value of the assets up to the date of conversion is taxed under the head capital gain. This was section 45 subsection 2. Then we come to next, that is section 45 subsection 3. It applies when the partner transfers a capital asset to a partnership firm, as we did in this previous illustration, or maybe association of persons or body of individuals, BOI, as the capital contribution may be. And these are the situations it often happens. In such a case, the transaction may not involve actual cash consideration because the partner contributes the asset in exchange for a capital interest in the entity. Therefore, the law provides that the value recorded in the books of accounts of the firm, AOP or BOI, shall be deemed to be the full value of consideration. This provision prevents disputes regarding the valuation and ensures uniformity in taxation. Next, we have section 45 subsection 4. This covers a situation where the firm or AOP, Association of Persons, or BOI, Body of Individuals, they distribute capital assets to its partners or members upon dissolution or reconstitution, not reconstruction, reconstitution. When such distribution takes place, the entity is considered to have transferred the asset to the partners or members. Since there may not be any actual sale price in such a transaction, the FMV of the assets on the date of transfer is treated as the full value of consideration. This provision ensures that the appreciation in the value of asset is taxed before the asset passes to the partners or members. And last on this slide, but not the last one, there are many more situations to be understood, is section 46 subsection 2. This section actually relates to the receipt of money or assets by the shareholders during the liquidation of the company. On liquidation, actually shareholders may receive cash or maybe property or any other assets in exchange for surrendering their shares. So, for the purpose of capital gain computation, the full value of consideration is calculated as the total amount of money received plus the fair market value of the assets that might be received on the date of distribution. However, from this amount, any portion already taxed as deemed dividend under section 2 subsection 22 para C is deducted to avoid double taxation. The remaining amount, whatever the remaining amount is, it is treated as full value of consideration for computing capital gains in the hands of the shareholders. So, I hope this is clear. These are different situations, maybe amount received by the insurance company, or there is a conversion, or there is a transfer of asset, or there is a distribution or anything else, or maybe the money received by shareholders. The amount of fair value of consideration, that is FVC, is accordingly decided. I hope this is clear. So we discussed this much today. For this session, we will continue in the next session with more nature of transactions deciding the different FVC. Thank you for today. Thank you.